I just wanted to talk about the paper that you released this week with Dave Richardson on taxing wealth better. Now, regular listeners of Follow the Money will understand why that's important, but for those who don't really know the arguments around why we need to tax wealth better, why is that important?
Australia's really bad at taxing wealth. We tax it really lightly compared to other developed countries. In fact, we're so bad at it, we don't have very many direct wealth taxes, almost none at all. But also, when it comes to things like capital gains, which is effectively the income stream from wealth, we tax that at a discount as well. So we tax it bad in all sorts of aspects.
And when we talk about wealth, how is that different to like the income tax that we pay, for example? What's the difference between those two?
Yeah, so an income is what you earn. It's a flow of money to you, and it comes in all sorts of forms. Most people are aware of salaries and wages is the main one, but you can earn interest, you can earn profit, you can earn income in all kinds of different ways. Wages, yep. Wealth is the stock of assets that you own. So if you take all the things that you own, the value of all the things you own, you take off all your debts, that's your net wealth. That's how much stuff you own. And while income is unequally distributed, we all know that, wealth is even worse. It's far more unequally distributed than even income. And so there are a small number of people who have a lot of wealth, which is why it's such a great thing to tax.
So you and Dave found that Australia can raise billions of dollars a year with just 3 policies. The first is a 2% wealth tax on those with net assets over 5 million. Take us through that and how that would work.
Yeah, so once a year, your assets would be valued. If you had more than 5 million in assets, then you would have to pay 2% of that net amount to the government in tax. And now, to be clear, if you've got more than 5 million in net assets, so assets minus debts, then you're in the top 5%. So we're only talking about a small group of people in that.
So 95 out of 100 Australians, this won't affect them.
It won't affect at all, no.
Yeah.
And also the tax would be excluding the family home and your super. All right. So
okay.
Even then, right? Like this will raise over $40 billion a year, to be clear, and it has enormous.
So it's only people with like a few spare houses and yachts.
Exactly right. Yeah, or enormous shareholdings, or assets like that.
Yeah. So that's what I was going to ask. So what kind of things are we talking about when we say assets? It could be share portfolios. It could be property,
investment properties, share portfolios, businesses that they own, those kinds of things. They're the main assets that it would probably target. These people have the most capacity to pay because they've usually got a lot of wealth, and so it's well targeted in that regard. But more importantly, it's a part of the Australia that is lightly taxed and not currently being taxed very well. And so what are the advantages of that? Well, it means that we can have better government services, and or we could cut taxes to those that are struggling. It's about sharing the load of taxation and finally capturing a group that's largely managed to avoid it.
Yeah. The second policy idea you outlined was scrapping the capital gains tax discount, as we just talked about before. It's obviously especially relevant for housing. So what are the reasons why that would be a good idea?
Well, the capital gains tax discount, if you earn income as a wage, for example, you pay your full marginal rate. If you run a business and earn profit, full marginal rate. If you get, dividends from companies, full marginal rate. Pretty much any way you earn income, you pay your full marginal rate, except for one, and that's capital gains. We treat capital gains entirely differently, and capital gain, to remind everybody, is when you sell an asset for more than you bought it for. That's a capital gain.
So you haven't necessarily, it's not like you've worked extra hard
exactly
or you've become more
yes.
productive. Just this asset that you own has appreciated in value.
Yeah, so if you work, you're creating goods and services. If you run a business, you're creating stuff. You're adding to the economy. Capital gain means you bought an asset and then you sold it for more. You haven't added anything to the economy.
So there's no good reason effectively why it should be taxed more lightly.
In fact, there's a strong economic argument that say we should tax this kind of passive income, this income that doesn't add anything to the economy, we should tax it more heavily than active income that's adding to the economy. But in Australia, we do the reverse, right? We actually tax it less. So the capital gains tax discount means if you made a capital gain of, say, $20,000, then the tax office says 10,000 of that is tax-free. That's yours. You can keep all of that. We'll only tax 10,000, half of it. And so it's a crazy system. It encourages people to earn income by speculating. So speculating is when you're counting on assets going up in price. It's added to the housing affordability crisis by encouraging investors to come in, speculate on the housing market, push the price up, and make it unaffordable. So not only would it make housing more affordable, it would also raise almost $20 billion a year.
Wow, so it's actually costing us a lot to give out this tax concession every year.
Absolutely. It's a huge tax concession. It adds nothing to the economy. It encourages speculation, and it's making our housing less affordable.
And who does it benefit?
Oh, overwhelmingly the top 10%. So over 80% of the capital gains tax discount goes to the top 10% of income earners.
Oh my God, over 80%.
Yep, it is almost exclusively to rich people or high income people.
Reverse Robin Hood.
Oh yeah, definitely. So this is a really bad tax concession, and it's costing the budget enormous amounts of money, and there's no good economic reason at all for it to exist.
Okay, and the last policy suggestion in this paper was an inheritance tax on large estates. This is the kind of thing that the media often takes as hugely controversial, but is it really?
I don't think it is as controversial. I think it's unknown. So Australia used to have inheritance taxes. About 40 years ago, they existed. Basically, they got rid of them, largely because Sir Joh Bjelke-Petersen, yes, that's how far back we're going, when he was Premier of Queensland, he wanted to attract old people to come to Queensland and live in retirement. And so he got rid of them as a way of attracting them. Come to Queensland, die here, it'll be cheaper. And so what happened is that other states, in order to stop this from happening, they also got rid of them. So it was really a race to the bottom. And because we haven't had them for so long, people don't really understand what they are anymore. And so there's a lot of fear around what they are. So just to be really clear, much like the annual wealth tax, this would only be targeted at people with really large estates. The vast majority of people...
Well, first of all, don't even own a house.
Yeah, well, exactly right. Increasingly don't even own a house. But even those that do, the vast majority of them will never have to pay an inheritance tax. It really is targeted at the top 5% or less. And it's a once-in-a-generation chance to basically redistribute wealth, which we know is excellent for the economy and society, and raise revenue that can be then used to provide services that Australians need and want.
And we know that this kind of inequality that comes from taxing the ultra-rich very lightly, it's actually bad for economic growth. Isn't that what economists have found over the years?
Absolutely. What they found is that more equal societies grow faster, have stronger, more robust democracies, and are less fractious and have less internal strife. And so reducing inequality is good socially, it's good economically, it's just good all round. I did some research a few years ago that found that countries with higher taxes are wealthier, healthier and happier. And this is one way of doing it, by reducing inequality, using that money to provide services that everybody has access to. We actually build a better society.
And correct me if I'm wrong, but a few years ago, you also did some research that showed that in the kind of decades after World War II, basically when the economy grew, most people shared in the benefits of that. So that old saying of a rising tide lifts all boats really was the case, and it was shared pretty equally kind of across the Australian community. But after the GFC, that really kind of changed, didn't it?
Yeah, absolutely. So back in the 50s and 60s, the top 10% got about 10% of the gains from economic growth, which means the bottom 90%, the vast majority of people, shared in 90% of those gains. But by the time we get to the GFC and that kind of decade between, just over a decade between the GFC and the pandemic, the top 10% got 93% of the gains from economic growth. 90%, the vast majority of people, only got 7% of those gains. So the vast majority of the gains from growth are going to a very small group of people, and that is causing enormous economic harms, but it's also causing enormous social harms.
So, yeah, if it feels like the economy is not working for you, it's not in your imagination.
No, it's genuinely happening, and wealth taxes is one way of correcting that.
Thanks for watching. If you'd like to keep up to date with all our latest research and work, sign up to our newsletter. Delivered every fortnight, it includes behind-the-scenes updates from Richard Dennis, an exclusive cartoon from Judy Horacek, details for our upcoming events and webinars, as well as explainers, graphs, and not to mention the latest cutting-edge research and analysis from the team here on the key issues that are facing Australia. Click the button on your screen to check it out.